The more that prices go up relative to the wages in the local economy, relative to what local people, families, couples can afford, the more prices go up, the way riskier that market is in terms of investment. How's it going, everyone? This is Nick. I am delighted to be back here with you guys. I have a massive episode in store for you guys, a super exciting episode. We are going to talk about what are the best cities to invest in real estate in 2021, and then what are the worst cities to invest in real estate in 2021. And this is such an important conversation to have right now because the U.S. housing market more broadly is in a bubble. You might have seen my 3-part series that just came out where I talked about all the reasons why the housing market is in a bubble and all the reasons that it's going to come crashing down. So when you have a general housing bubble across the country, it's never been more important to actually focus on the specifics of the cities and the markets that you're either buying a home in or investing in, or maybe you're thinking of selling a property in one of these markets. It's actually never been more important to understand the specific market dynamics, because let me tell you, the subsequent crash that's coming is not going to impact each market the same. There's going to be very big differences in how different cities and different markets respond to the coming crash. Some places are going to see 30, 40% price declines. Others are actually going to see stable prices and maybe even increases, right? And it's all about the fundamentals in these markets that's going to dictate that. So what I'm going to share with you guys in this video are 2 key indicators. These indicators, these stats are super simple. You can actually put them together yourself for your investment market. And despite their simplicity, they explain so much about what's going on in the housing market and whether now is the right time to buy or the right time to sell. And these 2 indicators are, number 1, value to earnings ratio. This is the ratio of home prices to wages in the local economy. And then number 2, rental yield, the type of rental cash flow yield that investors can get if they buy a property in a specific market. If you look back historically, these 2 data points are hugely predictive of which markets are going to be stable and secure in a crash and which ones are going to see huge price declines. By the end of this video, you guys are going to know the 10 US cities, the 10 markets that you need to avoid right now, as well as the 10 markets that you need to target if you're an investor looking for investment security in the 2021 housing bubble. All right, so let's just set something straight about the markets right now. I'm not going to repeat everything I said from my 3-part housing bubble series, but let's just run it down real quick. Number 1, prices in the US right now are at an all-time high, and year over year, we're seeing the highest ever increases in home prices that we have, especially adjusted for inflation in America's history. This is all happening when we're in a deep recession, right? There's over 7 million jobs that are still lost from the start of the COVID recession. So we're seeing record high prices, record job losses. That's a combination that doesn't make a lot of sense. It doesn't make a lot of sense until you start thinking about COVID and what COVID did in the short term. Basically made a lot of people scared to list their homes just at the time where it made other people wanting to buy homes. And that's why you're essentially seeing the low levels of active inventory, the low levels of supply that we're seeing right now. The problem is that there's nothing long-term or sustainable about this phenomenon. In fact, it's guaranteed to reverse at some point. The people who delayed listing their home, well, they're going to list their home. There's going to be a deluge of listings at a certain point. And as prices get higher and higher, there's going to be less and less buyers who can meet that demand. That's a recipe for a housing crash and a housing bubble. So if you want to learn more about that, that was a quick summary, but go into my video history. I have some links in the description, part 1, 2, and 3 of my housing bubble, housing crash series. But of course, as I just said, this housing crash is not going to affect all areas equally. In fact, the notion of a U.S. housing market is almost a misnomer because there's so many differences in cities and states across the country that you really need a more local view. We have over 500 metro areas across the U.S. where different things are going on in terms of prices, in terms of wages, in terms of jobs, in terms of new building and new supply, that you really need a local focus. And the first thing we're going to start with is a metric I call value to earnings ratio. The ratio of the typical home price to the average earnings of the average worker in the local economy. And this is a ratio that's hugely important for understanding the local demand and fundamentals in the housing market. It's this relationship which forms the key demand for, let's just say, families looking to buy a home in a market, or like a couple looking to buy a home in a market. It's really their earnings and their income which is going to dictate their ability to buy a home, as well as the type of home that they're able to buy. Right? Because after all, if you think about the phenomenon of buying a home, right? Like you go to the bank to get a loan, what's the first thing that the bank looks at? It's your income levels. It's your job. It's your income levels. Can you pay the mortgage interest payments? Do we feel like, if the property value were to go down, that you're a suitable, stable borrower? So it's income levels which are hugely important in determining home prices. However, when local home prices begin to detach from incomes and get much higher than incomes, that's a sign of instability in the housing market. That's a sign that your housing market is entering a bubble. And how do I know this just beyond theory? Well, all we need to do is just look back to recent history. What happened prior to the last housing crash in '07, and what were the markets that got hit the hardest? All right, guys, so on this graph, we're looking at the value to earnings ratio in 2007 for the different markets across the US, here on the x-axis, compared to what would amount to the decline in real estate prices from '07 to 2012 across these markets. So pretty much from '07 to 2012, that was like the huge housing crash in the US. Almost every market you can see is below 0%. Almost every market across the US lost value. And some markets you can see here lost 50% value, 60% value, 40% value. So the last housing crash was so bad, like so many people got wiped out. You're talking like home prices going from 400,000 to 180,000 in certain markets. Super painful. I love sharing this content with you guys. I spend a lot of time working on these videos. In return, I would just ask, hit the like button, please. If you hit the like button, that tells YouTube it's a good video, get me a little more exposure. Also, please leave a comment. I want to hear what you guys think about this data. I want to hear what you think about real estate. Please leave a comment. I make sure to respond to pretty much every single one, so please leave a comment. And if you haven't subscribed yet, make sure to subscribe, because I have this content coming out each week, 2 to 3 videos per week on real estate data across the country. Now, prior to the last crash, we could have actually predicted pretty well which markets were going to get hit hard, right? These red dots over here with 50-60% declines, versus which markets would have been more stable, right? More around 5% decline, or maybe it stayed flat, just by looking at value to earnings ratio in '07 before the crash. So again, we're taking the typical home price and we're dividing it by the average annual earnings for the worker in the economy. So let's just take an example here. Bakersfield, California. 2007, the typical home price was $294,000. That was a 7.6 values to earnings. Prices then declined by 55%. Reno, Nevada. Typical price back in '07 was $375,000. The value to earnings back then was 10.9. We saw a 55% decline. Compare this to some of the dots up here, maybe Pittsburgh. Value to earnings back then was 3.5. So prices were only 3.5 times the average annual earnings in the economy back then. And Pittsburgh actually grew home prices during the last housing crash. They actually went up slightly from 118,000 to 122,000. Markets like Buffalo, Shreveport, Louisiana, Oklahoma City, McAllen, Texas, Wichita, Kansas, Rochester, New York. These markets were the most stable. They held their values or even grew their values in some cases. And the reason was low value to earnings ratios, right? What that means is that the incomes in those local economies were more closely aligned with what prices were. Now I want to point you guys to this yellow shaded area, which I call the danger zone. And that's basically when the value to earnings ratio gets above this 6.0 level. So when the home prices in the market get above 6 times the average annual earnings, you could see in the last crash, those markets got crushed for the most part, right? We just talked about some of them. Let's talk about some more. Riverside, California, 11.4 value to earnings, prices went down by 51%. Sacramento, prices went down by 48%. Northport, Florida, Phoenix, Tucson, Boise, Seattle, San Francisco, LA. All of these markets had high value to earnings, and then prices collapsed. And it's so important that you guys understand this concept, because I think like the news media and realtors and brokers, they try to spin the opposite story. They try to spin the story that, oh, the more prices go up and the higher the prices are, the more secure the market is. That's absolutely not true. It's the exact opposite. The more that prices go up relative to the wages in the local economy, relative to what local people, families, couples can afford, the more prices go up, the way riskier that market is in terms of investment, especially late in the real estate cycle where we are right now. It feels like we're in the ninth inning. Maybe we're in extra innings of the real estate cycle right now. The higher the prices, the more the price growth, the riskier it is. Just burn that into your memory. That's what the historical data is telling us. Now, I think you guys are probably saying, Nick, all right, cool. I understand that. That was data from '07. How do I apply that to markets today? Like, is it the same markets today as it was in '07 with high value to earnings? Is it different markets? Like, how do I understand this dynamic today so I can make, real-time decisions, real decisions if I'm buying a home or investment property? How do I use value to earnings ratio now in 2021 to make decisions? A good way to start is by comparing markets by their value to earnings ratio in '07 versus today in 2021. Right? What's the relationship? Are markets more expensive, relatively speaking, today, or were they more expensive 15 years ago? Because again, in '07, that was the most bloated the real estate market ever was, and we had the biggest crash we ever saw. And so what we're looking at on this graph is we're comparing the two. So here we have the '07 values to earnings ratio of different markets, and here we have the 2021 value to earnings ratio. And what I want you to pay attention to is the color coding. So when you see a red dot, that means that market is more expensive now in 2021 than it was in '07 prior to the previous housing crash. So yeah, wrap your head around that for a second. These red dot markets, San Jose, Boulder, Fort Collins, Boise, Ogden, Denver, Austin, Salt Lake, Colorado Springs. These red dot markets are more expensive today. VE ratios are way higher in 2021 than they were in '07. So let's just take a market like Austin for a second. Back in '07, the VE ratio was about 5.8. Typical home price, 5.8 times average annual earnings. In 2021, it's up to 7.9. So what that means is that in Austin, home prices have grown a lot faster than wages and earnings in the local economy. On the flip side, the blue dots, these are markets with lower VE ratios today, meaning that they are more supported, more fundamental today than they were 15 years ago. Fresno, California is a great example. In '07, the VE ratio there was 11.8. Absolutely absurd. Today it's 6.7, still elevated, but at a much better level today in Fresno than it was 15 years ago. Other markets that are like this are Baltimore, Charleston, South Carolina, Orlando, Florida, Bakersfield, California, Allentown, Pennsylvania, Myrtle Beach, Cape Coral, Florida. These are markets in blue where prices relative to wages are cheaper today than they were 15 years ago. We got to start being concerned about those red dot markets where the VE ratios in 2021 are higher than '07. Just wrap your head around that for a second, like in Austin and Salt Lake and Boise and Denver. They are more expensive today relative to '07, which was the biggest housing bust in U.S. history. I wonder what's going to happen in those markets, right? Comparatively speaking, places like Fresno and Bakersfield and Baltimore, that doesn't necessarily mean they're good investments now that the VE ratios are lower, but it means they are much more secure than they were last time around, right? Earnings are much more closely aligned with values in those markets today than they were 15 years ago. And this is an important point to consider, right? Because things in real estate change. A market that's good to invest in, say, 5 or 10 years ago is not necessarily a good market to invest in today. That's how real estate bubbles work. Markets are good for a little while, then all of a sudden all the investor fanfare catches on, prices get bid up, it's no longer a good investment. Conversely, there's markets that used to be hot, that used to be attention grabbing, that are no longer as attention grabbing, and as a result, prices are lower, more closely related to incomes, and they're better investments than they used to be. And you can see what I'm talking about on this graph where we're comparing Salt Lake City, the orange line, to Miami, the blue line. And we're looking at the value to earnings ratios in these markets over the last 15 years. So if we zoom all the way back to '07, we can see that Miami had a super high value to earnings of almost basically 9.0, right? Typical price was 9 times the annual earnings in the economy. Salt Lake was around 5.6. So Salt Lake was much more affordable than Miami 15 years ago. Of course, Miami was one of the hardest hit by the housing crash. You can see value to earnings crashed, right, as prices crashed in Miami. But then an interesting thing has happened since then. Miami's regained value, but it's kind of stabilized at this like 6.8 to 6.9 VE mark now. Salt Lake has shot way above that, all the way up to 8.4. So now in 2021, instead of Miami being the expensive market, Salt Lake is the expensive market. So 15 years ago, Miami was the darling market for all the investors. Oh my God, no one can ever lose money in Miami. Well, all of a sudden, kind of the sheen came off Miami after the last crash. All of a sudden, Salt Lake is now that market in 2021, where all the investors, everyone's like, oh my God, Salt Lake, prices are only going to appreciate from here on out, and it's getting really, really expensive in a place like Salt Lake. Just to add some perspective, now I've added Buffalo, the gray line, to this graph, so you could see, right, we see big swings in places like Miami and Salt Lake, but Buffalo, basically the entire time, has stayed in this value to earnings range of 3.5 to 4. So Buffalo, not a sexy market by any means, not really much demographic growth going on in Buffalo, but, you know, it's solid fundamentals. The home prices related to earnings are pretty solid. They stayed in the same range, not exposed to the same types of swings that we've seen in markets like Miami and Salt Lake. Buffalo, right? I get it. No, people aren't excited by Buffalo. They're excited by Austin and Salt Lake City and whatnot. But just remember what happened back in '07. The markets that got crushed, the Tucsons, the Phoenixes, the Boises, the Sacramentos, the Renos, back in '07, those were the markets that were exciting, right? Everyone wanted a piece of those markets. Oh my God, the growth is never going to end, right? But eventually the growth did end, and it was a very painful decline. The markets back in '07 that didn't have the painful decline, those steady Eddie, boring markets like Rochester and Buffalo and Syracuse, those were the markets that withstood the crash. And if you were an investor back in '07 at the peak of the bubble, you would have done exceptionally better in those steady Eddie, low value to earnings markets. So VE ratio, that talks about how regular families, regular couples, regular homeowners are being priced out of the market. Now, I think I can already hear what some of you are saying. Nick, if regular families can't sustain the demand, I know who's going to sustain the demand: investors. Investors are going to come in and buy up all the homes. All the homes for investment. They're going to say, all right, I'll buy this townhouse, I'll buy this community of homes, and we'll rent it, right? We're going to rent these homes and earn cash flow. So the investors, those are the ones who are going to step in markets like Austin and Salt Lake and San Jose and San Fran. Those are the ones who are going to step in and sustain the demand. This is where now we need to talk about rental yield. Rental yield is very simple. It's basically the average annual rent that you can achieve in the market by renting out the property divided by the price that you pay for the property. Super simple. And like value to earnings, this metric is extremely predictive of how a market will behave in a crash, right? Markets with lower rental yields, with less cash flow to investors, have a lot more instability when a crash comes. Because those investors will say, oh, I got my appreciation, my yields are pretty low, let me take my profits, let's sell. And they'll all do it at once. In markets with higher rental yields, where there's more cash flow for investors, they are less inclined to do that. Especially in a low interest rate environment, they're saying, oh, I actually have pretty good yield, pretty good return on this house that I'm renting. I don't need to sell. And what we're seeing right now, especially over the last year or two, is that the rental markets in a lot of cities across the US have stagnated while prices have continued to rise. So that's compressing rental yields, that's making rental yields lower, that's giving investors less of a return on their investment. And in fact, in many markets, there's actually a negative return on your investment. If you want to buy a property and rent it out, you're actually the one who's having to fork over money to sustain it. And to see what I'm talking about, let's evaluate Austin, Texas. All right, so let's start super simple here. So we have Austin, Texas. What's the typical home price? Well, across the metro, it's $423,000 according to Zillow's ZHVI index. Typical home price is $430,000 in Austin. At the same time, according to Zillow, the typical monthly rent is $1,515 per month. That's $18,000 per year. It's the typical annual rent for properties in Austin. So we have a typical price of $433,000, typical rent of $18,000. What does that yield when you look at these two metrics together? That's a rental yield metric of 4.3%. So if someone were to buy the typical home in Austin and rent it at the typical rent, your revenue is a 4.3% yield compared to your purchase price. That is very low. As we'll see in a second, that leaves no room for profit on a cash flowing property. There's no room for profit at a 4.3 rental yield. And you can start to see that when we look at the mortgage assumptions, right? If someone wants to buy a property for investment, right? That $423,000 price, say they do a 20% down payment, your mortgage would be $338,000. Even at the record low interest levels of today, interest rates 2.7%, your annual mortgage interest, $16,600. So we can already start to see the problem here for investors in a market like Austin. Your annual rent is $18,000 and your mortgage interest at record low interest rates is over $16,000. Oh boy, that leaves very little room for cash flow profit. In fact, let's take a deeper dive into the pro forma. Your annual rent's $18,000, back out a 5% vacancy factor. Your taxes would be around $6,800 for this type of property. Insurance would be $18,000. A lot of properties in Austin have an HOA. You have some maintenance. All right, that leaves $6,600 of NOI, right? But we haven't even talked about the mortgage interest rate yet. So we're at $6,600 NOI. Now we got to back out the mortgage interest payment. Oh, we're at minus $10,000 cash flow after debt service. So this hypothetical investor in Austin who gets a 80% loan at 2.7%, we're paying $10,000 a year out of pocket for our investment property? Doesn't make a whole lot of sense, does it? So now you see the problem with relying on investor demand in these high price, low yield markets. Like on one hand, we've already established that regular families and regular homes have been priced out, but investors have also been priced out. If an investor cares about cash flow, you are making no money. You're actually having to pay money. In Austin, Salt Lake, San Francisco, other markets like LA, Boise, Denver, you're actually having to pay money out of pocket to own an investment property. Now let's think about the Biden capital gains tax suggestion, the 1031 exchange suggestion. All of a sudden, it's going to increase your taxes, right? If you go and sell your investment property, it's going to increase your tax burden on appreciation. Right, all of a sudden, you're going to go from paying 20% capital gains tax to 40% capital gains tax. That's obviously a huge incentive for especially investors to sell their properties and capture their gains before the tax rate goes up. I think everyone would kind of agree with that, right? It's especially an incentive if you're in a market where you make no cash flow. If you're in a market like Austin and you make no cash flow on your investment, or you're having to pay out of pocket to float your investment, damn, that property gains tax increase comes through. You don't want to be around for that. You want to lock in your appreciation. After all, you basically bought in this market for appreciation. You have no incentive to hold at this point because your cash flow isn't there. I'm going to rush to the door. And as soon as I sense that either the market has peaked or that this capital gains tax increase is going to come down the pike, if I'm an investor in Austin, Salt Lake, Denver, Boise, LA, San Jose, San Francisco, if I'm an investor in any of these markets, I am taking my gains because there's no reason for me to stay. Now, we spent a lot of time talking about the high price markets. What about the opposite end of the spectrum, right? The markets with higher rental yields. Well, it's the exact opposite in these markets. Because they offer higher returns, say the rental yield's 7-8% instead of 4%, rental investors will actually earn cash flow. So when the capital gains tax increase comes down the pike, they'll be less inclined to sell because they'll say, all right, maybe I'm not going to make as much on appreciation after I pay my higher taxes, but I'm still earning a good coupon. I'm still earning a good cash flow return from my property here. So I'm less inclined to sell. All right, so now we have these two dueling concepts. One is value to earnings ratio. That's talking about the fundamental ability of families and couples and households in the economy to buy a home. Then we have rental yield, which is talking about the fundamental demand and ability for investors in the market to afford homes and to cash flow from those homes. Now we combine these two concepts together to say, all right, what are the markets that we need to avoid in 2021? What are the markets with tons of downside risk? And then what are the markets with more security? What are the markets where even if I buy in 2021, even if I buy at the peak of the market in general, I feel much more secure buying in markets with low VEs and higher rental yields. And that's exemplified here on this graph. So we're looking at risky markets, these are the ones in red, and we're looking at more secure markets, these are the ones in blue. So the ones in red here in the top left, they have low rental yields, let's just say below 5% rental yields, and they have high value to earnings ratios above 6. So to repeat, these markets would be San Jose, San Francisco, LA, San Diego, Boulder, Colorado, Seattle, Salt Lake City, Provo, Denver, Boise, Fort Collins, Ogden, Portland, Austin, Sacramento. These markets are fundamentally risky. In 2021, at the ninth inning of an economic expansion, these markets have much more downside than the markets in blue. The markets in blue have higher rental yields above 6%. They have lower value to earnings ratios, below 5.5. These type of markets would be Akron, Little Rock, Birmingham, Cincinnati, Baton Rouge, Indianapolis, Oklahoma City, Cleveland, Augusta, Columbia, South Carolina, Rochester, Greensboro, Winston-Salem, El Paso, Texas. It would be much more difficult for a crash to severely impact these markets in blue because, okay, say prices do peak, say the capital gains tax does get passed, that increase does get passed. All right, there might be a little turbulence in the market, but because prices are low relative to wages and relative to rents and cash flows, there will be that demand to backfill once the crash occurs. I don't see where that demand is coming from for these red dots. These red dots look a lot like those markets back in 2007 that got hit really hard. I can't stress enough, guys, how important it is to use data that provides context, data that provides historical context. It's so important to look at this stuff because if you don't, you're just going to be the victim of whatever the local realtor, whatever the local owner, whatever the local news reporter says, or some other unscrupulous YouTube channel. You're just gonna be the victim of what they say, and there's gonna be no proof. You're gonna have no context or evidence. So look, I'm not saying that my methodology is 100% accurate, but it's much better to make these big financial decisions about where and when to invest by using data. And this is data that you can get yourself. You can go to Zillow and go to their data page. I'll have a link in the description. And you can download data on monthly prices and monthly rents, and you can calculate rental yield for your market and see how it's changed over time. You can go to the BLS website. You can get data on annual earnings. I'll have another link to that in the description. You can calculate value to earnings for yourself. Now, if you guys are disappointed that I only post 2 to 3 videos per week and you want more real estate content, more economic and demographic data, make sure to follow me on Instagram at Reventure_Consulting. That's at Reventure_Consulting on Instagram. I post new graphs, new maps, new charts every single day. And I also post stories of me explaining what these graphs, maps, and charts mean. So if you're a home buyer or investor who wants to learn more about how to use data to analyze markets, definitely give me a follow on Instagram at Reventure_Consulting. All right, guys, I hope you enjoyed this video. Again, I put a lot of effort into these, so in return, just please leave a like if you enjoyed this video. Please also make sure to comment and also make sure to subscribe if you haven't done that yet. I have this content coming out every single week. Next week, we're going to do a video on Charlotte that drops Wednesday. So you're not going to want to miss this content. Make sure to subscribe. All right, guys, until next time, this is Nick from Reventure Consulting signing off.